Oh, hold on one second. I think my cat is stuck in a cabinet. Hold on.
I haven't heard that one.
How does a cat get in a cabinet?
Because my son left the door open to the cabinet and like that's where their
Got
cat
it.
food is. So they jump in the cabinet all the time and they hide in the back. So I closed the door and my other cat was like jumping at the cabinet door. So I knew he must have been stuck in there. Which he was. They're going berserk today. It's a
I
weird
thought
day.
you might have had like the baby locks or something. So it got
I
in, but couldn't
know,
get out.
like
Oh yeah, yeah.
it's not that they can open the door. My son opened it to get a snack out of there and then he left it open or the cat got it. I don't know. Something, whatever. Mom life. Mom
Never
life.
a dull moment.
I know. Well, all right, here comes a couple more people. Oops, sorry guys. I'm gonna get us going live on Facebook so we can get going because it's a little after 11. Oh, it looks like it's gonna be weird again. Let's see. Yep, Facebook is weird. It's not letting me put it in the group.
Weird.
It says share to my page or share to my timeline. It won't let me share it to the group. Oh, yeah. Okay, we're just gonna have to put the link to the video later.
Yep, that's fine.
Michelle Kiplin's in here.
Yeah. Do you know Michelle?
I do. Yeah. Good to. I can't see you, but a long time. Hope you're doing well.
Yes. Yes. And hope you're doing well too. It's great to see you and great to have you on today.
I'm not on the beach, but you know it is nice out today. So.
Must be nice because it's rainy and gross here. So
Where are you? Where are you calling in from?
I'm in Ann Arbor, Michigan.
Oh, okay. Oh, I guess I'm in like a dark room, so maybe I'm thinking of yesterday because I think it is supposed to rain today, right?
It is supposed to. Well, at least that's what it says, but it hasn't started yet.
It's not supposed to start till after 1.
Okay.
So
Good
we're
to know.
good in our area.
That's when we should be going into work then.
Yeah. Yeah. I was in a house the other day and it had like, it was Friday, I think it was. It stormed really bad the night before. And this house, literally, the whole back half of the house had like no roof. And
Ouch.
so the house just smelled terrible
Ugh.
because of all the rain and it was so gross.
Yeah.
Yeah.
Sounds awesome. Don't you love the stuff that we have to deal with? All right. Well, we're at 11:04 now here. So why don't we go ahead and just get started with Travis? So let me pull up. I want to pull up your credentials here because we have your whole little info.
Do you want me to share my screen or you can let me know?
Whenever you want to. Yeah. So you're a financial planner and you're the owner of Wurz Financial Services. You specialize in working with real estate agents to help optimize cash flow, plan for retirement, build wealth, and create future passive income, which we all need and love and want more. So this is the guy. This is who we need to talk to today. So
Can you see my screen?
we can,
Yes.
yep.
Okay,
So
good deal.
you're gonna
I'm
be
glad you did Zoom because like anytime I jump on a Teams, I'm so used to Zoom, you know, hop on one of these other platforms and I always feel lost. So this is good.
Welcome to Zoom. Welcome back. You guys are going to be seeing a lot of Travis. We have him scheduled out for like 3 different dates. So over the next month, you're going to be seeing a lot of him. So he's going to be like our
I
special.
like booked up your whole calendar.
I like it. So, well, without further ado, why don't you get started?
Yeah, no, thank you so much, and appreciate you having me on. We were talking about, hey, maybe we should have done this before tax season, but you know, it's probably fresh in everybody's mind if you got done with your taxes. But this is probably the best one. You usually save the best for last, but I have some other good classes. We'll hop on other weeks. Uh, Talk about some things today to, you know, tax savings, but more about how can we keep more of the money that we're making? I'm self-employed, and everybody here is more or less self-employed. So, taxes can not get put on the back burner, but they could be more complicated. And I'll find a lot of times with a lot of my realtor clients, and I find that people will come in the business and they're just like, you don't go, at least in my experience, a lot of people I talk to, they're not put through a class of, okay, like, here is what you need to expect when you're doing your taxes. And it's just like, okay, here's the reins to being a business owner, and you're just going to have to figure your taxes out. So hopefully this will be enlightening. I'm going to run through kind of quickly on some things, so you can reach out with any kind of questions you might have. But a little bit about me. I know you mentioned previously, but my name is Travis Wurz. I'm a financial planner. My brother and I own a business, Wurz Financial Services. He works with attorneys. I specialize in working with real estate agents. I'm not really sure how that came about, to be honest. It's kind of a funny story. I think it was just, when I came in the business, realtors were picking their phones up or something along the lines of that. So, I ended up picking up a few clients, and then through that started teaching classes and building on it. And yeah, so it ended up being a good thing because I really enjoy working with uh, people that have a different story. I'll find, a lot of agents, it's not like you get the same kind of person, right? Like a lot of people are like retired and they're now, selling homes, or, this is their first career. You get everything in between. Um, as realtors, you're familiar with these things, but like we deal with fluctuating income, being self-employed, and really just like, wouldn't it be nice to have a 401k match? Like you put money in and your broker matches it for you, and things that are taken for granted that we don't have being self-employed. So I want to uncover a couple of these things. Let's go. I'm used to clicking my space bar. There we go. Does anybody file as an S? Well, I guess I can't see your raise of hands, but some of you may have heard this, or you know somebody that files like an S corporation. This is going to be one of, in my opinion, the biggest tax savers for a lot of self-employed people. It's something that you can run past your CPA. If you need a CPA, I can refer you to some. But I just want to show you how this strategy works, how it might work for you. But basically, how it's how can I keep the most of my income? When you come in the business as a realtor, it's really no different than if you were to go start a lemonade stand. All of the money that you make is subject to self-employment tax. If you're a real estate agent or you own any kind of business, any self-employed person. Now, what that means is you're paying your federal, you're paying your state, but also all of the money that you make is subject to this self-employment tax, which is 15.3%. It's split up between Social Security and Medicare. And then if you make over 168,000, it goes away. You still pay for it like under, but let's say you make 200,000, you're not paying this, most of it anyway, above that 168. Also, I don't know if any of you have been audited. I have not been audited. I can't imagine they're a whole lot of fun. As a sole proprietor, the audit rates are the highest, the success rates are the lowest, and probably, the biggest, or the thing you've heard the most is there's no separation from your business. You are the business is you. Um, there's not necessarily, this isn't a bad thing. I was a sole proprietor for, I mean, to be honest with you, until 2022, I was a sole proprietor. Uh, Now, what does that mean to be taxed like an S corporation? Maybe you've heard of this, or you know somebody that does this. Basically, it's not a strategy to reduce your federal taxes, but that 15%. It's like, okay, like if I make 100,000, I'm paying federal, I'm paying state, and I'm paying this 15%. So I'm paying a whole lot of taxes. So this is a strategy on how can we reduce that 15%. And basically what you do is you pay yourself a salary on paper. And I'm going to get into this. I even have pictures. If you're like a visual person, I've got real nice like flow pictures. But basically, you're going to pay yourself a salary, and you're only paying that 15% on the amount that you're paying yourself. Now, where people get confused, and even where I was confused, is like, how does that work? Like, okay, if I'm paying myself a salary, what happens to like the other money? And I'll get to that. But there's two ways you can accomplish this. You can set up an S corporation for your business, or the way that I did it, and I think the easier way, and most of you might even already have an LLC, but you can set up an LLC and you can choose to be taxed like an S corporation. And most of you maybe probably should have an LLC anyway, or maybe you do. So basically, with a corporation, they pass the income and losses to the shareholders, kind of by definition. But what that means is that you can pay yourself a salary from your business. Instead of you being the business, you have a business that pays you, if that makes sense. So kind of how does this work? Maybe you already have an LLC, but the first thing you would do is set up an LLC and talk to your accountant, or elect to be taxed like an S corporation. And you actually can set this up pretty quickly. We were talking about being a procrastinator before everybody hopped on. I set this up like mid-November, early December. Like I sent my accountant an email. I'm like, hey, I know we have a month left of the year. Could we get this set up? I wouldn't recommend doing that, but you can set this up. And it's a good thing we're talking about this after we've done our taxes, because this will really apply for, this year when you're doing your taxes, and next year for this year. Set up an LLC, set up a business bank account in your LLC's name, and you have to hire a payroll company, or your accountant might also do this. There's a company out of Toledo I use. They're like $30 a month. And basically what they'll do is they will create they'll pay you, monthly, your salary. They'll move it from your business account to your personal account. They'll withhold taxes and everything like that. So all you need to do is leave enough money in your business account to cover payroll. Okay.
I have a question, Travis.
Yes.
Do they also take care of filing like your workman's comp stuff and anything like that, or do they just do your payroll?
My payroll company, is that what you're asking me personally?
Yeah.
They file everything, mostly just payroll. So they'll give me, like, I have a monthly pay stub, they give me a W-2, and then they're withholding taxes for federal and state and all that. Even if
Okay.
you're not, I'm not sure how but like in our business, we're technically exempt from state tax. So like you pay it and then you get it back, but they withhold all the taxes, just like a
Okay.
normal payroll tax. It's almost like you're working for like a company.
Right.
And you are right, like your own company, right?
Yep. Yep. Okay. Thank you.
Yeah, sure. So that'd be the first step. Set up an LLC. If you have a CPA, they might even be able to do this for you. I mean, this is the route I took. I said, just let me get this set up. They can run an illustration for you. Say, hey, like last year I made 200,000 or 150,000. What would it look like if I did this S corporation? And they should be able to run you an analysis and show you, hey, you would have saved X amount, or this, that, and the other. Setting up a business bank is pretty self-explanatory, but it will take a week or two for the LLC's information to show up online. So like if you're like me and you were doing it right up to the wire, you got to set up the LLC, and then it takes about a week to be able to set up that business account. Once you have your LLC and your business account, you can establish a salary. The IRS just says you have to pay yourself a reasonable salary. You couldn't pay yourself $1, or $10. It needs to be reasonable. And that is going to be between you and your CPA. It must be, I can't give you there's no formula, if that makes sense. And then the payroll company. So there are inexpensive ones. They set up a monthly payroll, just like if you were working at a company. A lot of CPAs offer this service, like I mentioned. And like I mentioned again, let's say you're paying yourself $60,000 a year. You want to leave, let's just be basic, $5,000 a month in your business account to cover the payroll. Okay. So let's say we got Mary, she makes 100,000. She would pay potentially $15,300 in self-employment tax at 15.3%. So let's say she sets up an S corporation or an LLC and then tax like one, and she pays herself 50,000. So instead of being taxed on the 100,000 in self-employment tax, she's only being taxed on the 50. Easy math, so half as much. So she would potentially be saving, $7,650 in taxes. Now, there are some expenses to think about too. So, you're saving this money, but it might cost you a little extra in having a payroll company and having your, CPA. But a lot of times I find it still is worth it after expenses. If you're a visual person, here we go. So you get your checks. This is how I find a lot of folks, and I've done this too. Your checks go into your bank account. You pay federal tax on your $100,000 check. You pay self-employment tax on your $100,000 check. And you just, push money into your personal bank as needed. The difference here is all the money you make is still going into your business bank account. The only difference being it's a formal salary. Instead of just like taking money out as you buy a, dog or a house or whatever, you have this formal salary that's going in at fixed each month. Now, my question was always like, what happens to all this other money? Like, I could never understand this. So I'm like, let's say I make $1 million and I'm paying myself 50 grand. Okay. Like, where does the other money go? And the answer to that is you can still draw it out. You're still paying taxes on all the money you make. Just the self-employment taxes is where this is saving you. So you can draw the money out. You can draw all the money out if you want, but you want to leave enough in here. We're actually going to have another class on like budgeting and managing cash flow and figuring out like how much do we need to leave in the business account. But hopefully that makes it. If anybody has questions, you can just kind of like, I see some people in the chat. I don't know if that's the payroll tax is more or less that self-employment tax. Was that the question you had, Nikki?
Yeah, it was because so one thing when I had set up my S corp and was having payroll done, one thing that I wasn't expecting was the additional payroll tax. And so, and it was substantial. It was, I was like, why are they taking so much money out of this? So yeah, that was
because that's the 15%. Because you're paying. The reason it seems like so much is because when you pay yourself, let's say you're paying yourself 10 grand. Okay, they're going to withhold federal. They're going to withhold state. Then they're going to hold self-employment tax or it's a payroll tax. So it's probably like 35%. I mean, it could be like 35%, right? Is that what you mean?
Yeah. And I didn't understand why it was. So what you're saying,
because it's all being taken out of that number. And then the rest of the income, like there is none of that. And it seems like a lot because it's just all being attacked. Like all the big tax is being attacked on this money. But if you didn't, let's just say you didn't do this, you just had everything go in your bank and you wait till the end of the year, you would owe substantially more. So, but I know exactly what you're talking about.
and nobody warned me about that. So how you just explained it makes a lot of sense now. So thank you.
Yeah, and the budgeting thing too. So like I will say this. I was the kind of person I would wait till the end of the year and not I would wait till I wouldn't pay any of my quarterly taxes. I would just like work. I just like put my money in a separate account and then in April write this big check to the government. And
then you wanted to throw up.
No, it's never fun. It feels like you're working for the government for the first like 3 months of the year. Now, when you do this, the tables get flipped because now you went from being basically a year behind to now you're like paying it for the current year. So there is a budgeting, like it's almost difficult to switch because, oh shoot, like I was waiting till the end of the year. I just paid all my taxes for last year, and then now I have to shell out more money every month. So it's something you want to prepare for. But it's probably a good idea to get kind of on track anyway. Anyhow, advantages and disadvantages. Obviously, the potential savings. You separate the business from your personal assets. It is more work to set up. I think this is going to be a common theme. It's more work to set up. It's going to take some effort, and you're going to have a few extra expenses. The accountant's going to have to file a business tax return, and you're going to have a payroll expense. You're going to be paying less into Social Security. When you go into socialsecurity.gov, you're going to see the amount that you're paying yourself. Now, it's going to be up to you, or your financial person, or we can have a meeting, or your accountant to determine, like, is the tax savings today, worth it in the long term. And the second, I put the two biggest tax savers that, I want to help people save money in tax while keeping their income. Okay. So, like, you don't want to say, well, like, I've run into some people and they say, well, I didn't have any tax because, like, I had so many deductions. Like, I didn't have any income. Like, I made all this money, but I spent all this money. And, like, that's great to pay no tax, but, how about not having as much tax, but also being able to, keep the money? So, retirement account contributions are a great way to do that, because you can quite literally keep the money and get a deduction. Most of you are familiar with this, but contributions to retirement accounts are generally tax deductible. You may have heard the word pre-tax. Pre-tax means that it's subtracted from your taxable income. So you make 100,000 and you put money into a pre-tax account. Let's say you put in 5,000, your 100,000 is now 95. You're putting the money into the account, has never been taxed. And that's what pre-tax means. All of you have probably heard of a traditional IRA. Contributions are generally tax deductible and pre-tax. You can put away 7,000. If you're over 50, they give you another 1,000. I've always said, if I'm president, I'm going to double it. I'm like, they only give you 1,000. What kind of a catch up? You can do this husband and wife. So if you're married, you can each do one of these. You may have heard of a SEP. It's the way I explain it. Everybody can do a traditional IRA. If you're working at Apple, if you're a realtor, as long as you have income, you can do a traditional IRA. It's an individual retirement account. Now we move into a business account. You can set up a SEP IRA for your business. So most people will have a business retirement account, and you can have a personal retirement account. Even if you worked at, like, Amazon or a big company, they might have a 401k, and you can also do an IRA. A SEP is popular because they're very easy to set up. The contributions are tax deductible. You can put away 25% of your compensation up to $69,000. A lot of money. They're easy to set up. You can set them up for the prior years. There's no extra fees or costs or anything like that. But they only allow pre-tax, and that'll mean something in a second. So if you're just looking for more tax deductions, this is a great place. A solo 401k is kind of an alternative so everybody can have an IRA, and then we get to the ORs. So you can have a SEP, or this is an alternative to a SEP. I find a lot of people not talk enough, in my opinion, about solo 401ks. When I found out about, like, everybody's heard of a 401k, but when I found out you can create a one-person 401k for really not a whole lot of expenses, and for the benefits is huge. So I'll run you through it and who it might make sense for and who it might not. The biggest thing for me is, and I'll talk about this in a second, contributions can be Roth, but you have options. So basically, you contribute as the employee and the employer. You've got like two people, all right? You got the employer and the employee. You can contribute $23,000, even if it's 100% of your income. So if you make, geez, I keep skipping, sorry. Okay. If you make $23,000, you can contribute the whole $23,000. If you make $20,000, you can contribute $20,000. It can be up to 100% of your income. But you can choose if you want to put it in as a Roth or if you want to put it in as a pre-tax, take a tax deduction. They give you an additional $7,500 if you're over 50. On top of this amount, you can do an employer contribution, okay? Very similar to a SEP, 25% of your compensation. The limits are the same, but they give you this extra like 50 and over deal. So 69,000, if you're over 50, they'll give you another 7,500. Now, I'm not walking down the street and meet a lot of people that are, bagging $76,000 a year from their income, but I'll show you some examples of where this can be useful, maximizing deductions, the Roth, and the contribution limits. Very similar to doing an S corporation, it just takes a little more work, right? So you have to have a third-party administrator. I have a company I use. They're $300 for the year. Because it's a 401k, you need somebody that is going to keep track of the plan, make sure you're following all the rules. They file reports. We use a company, July Business Services, and they do this. So it's just an extra expense. Other than that, you open up a 401k account. We use Charles Schwab, and you can contribute and invest the funds. And the TPA will keep track of like how much was for this year, how much for last year, what was employer, what was employee, what was Roth, what was this. It all goes into one account, and they keep track of all that. Now, what's the advantages and disadvantages? What would be the plan for you is really going to depend on, what are you looking to do? The solo 401k, or I call it a solo K, they do offer the highest contributions, and they offer Roth. So, I'll get into this in a second, but you do need a third-party administrator, and it does cost a little more, and you can't set it up for the prior year, which is a good thing and also a bad thing. It's a good thing for me, when I have clients, they'll call me a day before taxes are due, and they say, hey, I need to set up a SEP for last year. Because you can do that. You can set up an IRA or a SEP IRA for last year, like up until you file your taxes. This has to be set up by the end of the current year. Like you got to set it up for 2024 now. You can't set it up in April of 2025 for 2024, if that makes sense.
I have a quick question.
Yeah.
If you set it up like the example you just said, and you want to set it up for the previous year,
Mm-hmm.
do you then, how does that work? Are you like, hey, I want to move $20,000 into this SEP IRA for last year? Is that kind of how it goes, or?
Yeah,
Okay.
exactly. Now, a SEP, you can do that. You can set it up for the prior year. A solo 401k, you cannot.
Right.
But you just need to be eligible to make the contribution. Like you have to have the income to do it.
Right.
The money doesn't necessarily have to come from like your income. I mean, it should, but doesn't have to. But you just need to you couldn't put a 50,000 if you made 10,000. Like you need to have the income on paper to do it. Does that make sense?
So, yes. So if it didn't come from your income, would it come from your business then?
It technically should come from your business account, but when you're
Okay.
self-employed, like you are the business, so
Right.
it really doesn't matter where the money comes from.
Okay.
It could come from your personal account, and you would just keep track, and
Okay.
it might count against like how much you drew out of the business. But
Right.
it really doesn't matter. Like it's not like if you had employees that you were paying like a W-2, then things would get messy and all this wouldn't apply. But since
Okay.
we're all like we are the business, it really everything's going to flow to us anyway on the tax return, so it doesn't really matter where it comes from.
Okay, so it doesn't matter that we are the only employee, the only W-2 employee.
Yes, exactly.
Okay, thank you.
So this is a fun fact too. To fund the maximum in a SEP, to fund that 69,000, you would need to make 276,000 in compensation, like after your deduction and that stuff. To fund the maximum in a solo, you need to make 184,000. Now the point I'm trying to make here isn't like, hey, like, if you're making 184, you can, are you going to save 75, 73,000 because they give you a catch up? But at income levels, you can put away more. Like if you're paying yourself with an S corporation, a salary, that's what your contributions are based off of. So I'll talk about this in a second, but actually I'll skip ahead. When
So
you're
do you,
paying yourself, let's say a salary of 60,000, I had this happen with a client. She was a realtor. She's always done a SEP. I told her about the solo. She said, well, we'll just, let's put it on the back burner. So, well, I can only she's used to putting away 30 grand in her SEP because she's making 300,000. Well, now she can only put away 15 because she's only paying herself 60,000. So they work in conjunction really well with an S corporation, because if you want to continue to make the contributions that you have been, you can still pay yourself that salary, and you can pay yourself 60 grand and contribute 45,000, which is crazy to me.
so here in Michigan, we have to be brokers in order to have an S corp, from what I was told. We cannot file a S corp unless we are brokers.
That doesn't make a whole lot of sense to me.
I have not heard that. And I say this because a lot of agents in Ohio are also licensed in Michigan, and they run it all as one business. I mean, okay, so for me, example, if I was licensed in Michigan, it's all under my LLC that files as an S corp.
So we looked into a company that Christina Swires had suggested, and they do some financial stuff. And a majority of it is filing through your S corp. But in Michigan, they told us in Michigan, we had to be a broker and we had to be working under that broker license number. And like basically you couldn't do S corp instead unless you had that. And because in Michigan, we cannot be paid from our brokerage to an LLC account unless we're a broker. So all my commissions go into my regular bank account. It can't go into a business bank account with an LLC.
Who told you that? Because
that's the rule. If you like EXP, if it gets noted that the LLC is getting paid, if they catch it, they will make you go to a personal bank account. So in Michigan, it's tricky. But maybe because you have one going for a different state, they allow it. But here, like people do it, but once it gets caught, they make it get switched over to a business or to a personal account. So like I could do, like if I had a separate business checking account, just, not with an LLC, but like a separate account, I could do that. But I couldn't do an S corp and I couldn't do an LLC bank account.
So the LLC files as an S corp. It's not actually set up as an S corp. And to have a business bank account, don't you have to be an LLC?
Yeah, that's why I can't pay like if I had a separate bank account that was just like a different account, like a separate checking account, I could do that. But if it's got an LLC connected to it, I can't do it. It's whatever Michigan's rules are.
I'll have to get back to you on that. What about a corporation? They let you pay yourself if you're a corporation, or is it just the LLC?
I didn't look into that. I looked into trying to do an S corp, and the brokers were saying that, in order to be able to do it or pay your LLC bank account, you have to be a broker, a licensed broker in the state of Michigan.
Okay.
So I have not looked into it just because I'm not a broker.
That's interesting. I'll get back to you on that. I'm gonna plead the fifth on that one.
All right.
So
I would love to, because
yeah,
I feel like there's benefits to it, but if you
sure.
can't because you're not, it's
Yeah,
annoying.
let me get back to you on that. Either way, the solo 401k is applicable. It would just be, you can do this you don't have to have an LLC to do a solo or a SEP. But
Yeah, see, Jackie said she's heard the same. Yeah. And I know, even for instance, like Nikki Julie had her business, like all of her income going to her LLC account. They noticed it and they bumped it out. But now that she's a broker, she can get paid to her LLC account.
interesting. Cool.
That's
No,
good too. So I'm sorry, I'm like totally going off topic though, but that's
no,
why,
that's
like,
cool. Yeah.
for our business, we had a team, and the bank account had to have, or we had to have Corinne as our branch officer, or our branch team lead. So all the money would be funneled into the LLC account because she was the broker of our office. So
Gotcha.
like there's so many loopholes and hoops to jump through. But
That's
anyway,
annoying.
sorry for hijacking your presentation here.
That's okay. I'll get back to that. I'm gonna do a little digging too. But regardless of the 401k, will still apply. But I was mentioning it can work well in conjunction if you are somebody that's filing as an S corp. I'll go back here. I'll give an example of Jeffrey that's 50, makes 100,000. Not to play a comparison game, but like where would this make sense? If you make 100,000 and you're over 50, you can contribute 23,000 plus the catch up plus an additional 25,000. So potentially you got 55,500 you could contribute to a solo 401k, where if you were in a SEP, you could only do 25,000. Now, this doesn't apply to everybody. Like I mentioned, a lot of people I talk to aren't making 100,000 and saving 55,000. But I'll give you an example. I had a client recently, and he came to me, and he had a year where he just made a lot more money than usual, and he had existing money that was just in a bank, not in a retirement account, and he wanted to, set something up. And we used a 401k because, okay, we know we can contribute 25,000 to a SEP, or maybe we can take some of this other money that you got from selling a house or something. If you qualify to make a contribution to your 401k, we can take a bigger tax deduction. So it can be a very useful tool if you have money that's not in retirement or in a taxable account or something like that you want to push into retirement and take a tax deduction on, if that makes sense. This is my favorite part. I always say I'm not like team Roth or team pre-tax, but like the more I go down this path, I feel more team Roth. So everybody's probably heard of Roth. It basically works in the opposite as pre-tax money. When you put money into a Roth, you don't save anything today. You make 100,000, you put $10,000 into a Roth. You don't save anything today. You don't pay anything extra today. That money just goes in, and whatever happens to it is tax free when you retire. So it grows tax deferred and tax free. When you are 59 and a half, the money is 100% tax free. When you die and your beneficiaries inherit that money, it is 100% tax free. There's no required minimum distributions. When you reach 73 years old on a pre-tax account, the government comes knocking on your door and says, hey, we noticed you have this money. You have to start taking out an RMD. You have to start taking money out so that we can tax it. And, so I'm not saying one is better. I mean, personally, I've gone down this Roth train just because I don't want to deal with taxes when I'm in retirement. And it can make sense, not to do Roth also. I work with a lot of clients that are in retirement, and I'll just say not a whole lot of people are happy about paying taxes in retirement. And a lot of the thinking was, okay, like save the money now, put it in a pre-tax, put it in your SEP now because you're working and you're making more money, and then you're going to pay it when you're retired because you'll be you won't have all this income and you're going to want to pay it when you're retired. And that sounds good. And in theory, it can work if tax rates stay the same. If tax rates go up, like maybe that doesn't work. But there is one common denominator where just like my clients that are retired just don't like paying taxes. And what ends up happening is, let's say that you're retired with a spouse and like one of you passes away, and now you're a single filer, so your tax rates are higher, or you die and pass it to your kids and they have to pay tax. So there's a lot of reasons where Roth can make sense, but it's totally a personal choice and kind of a like give and take. Like, are you willing to pay a little more taxes now to have tax-free money later down the road? The idea is you technically pay the tax today, you pay the tax on what you make for tax-free money later. So you potentially save taxes by eliminating them. The beneficiaries inherit the money tax-free, and there's no required minimums. I've always said, tax is kind of unavoidable. Like even if you're paying yourself a salary, like with the S corp, you're paying less into Social Security. Like there's always this give and take. You can save the money today by putting it in an IRA, but then that money will be taxable at some point if it's when you pass away or when you take the money. So, it's kind of unavoidable if you pay the tax today or you pay it later. There's a lot of uncertainties. I mentioned like, what's tax filing going to be like? What are future tax rates? I know all the tax brackets are going up 3% that next year. So, like, I don't know, like what are taxes going to be like in 20 years? Like, I have no idea. So the idea with Roth is this is a place you can put money and potentially grow it tax free. I've always felt the government will never get rid of Roth because they're like, okay, like sure, pay your taxes now, and then it's just whatever you do with your, like, they're not going to give you a tax deduction if you lose the money, and it's just kind of on you to grow it. Everybody's heard of a Roth IRA. You can put $7,000 a year or $8,000 if you're over 50. But once you make over a certain amount, they'll say, hey, you make too much money, no Roth for you. And this is where the solo 401k can become very valuable because you can contribute $23,000 or $30,500 to a Roth with no income limits. And it's huge. And you can actually do more than that, and I'll show you in a second. But let's say, like a fun example, let's say you could put 10 grand into a Roth every year for 10 years, and you could make, 10% a year on your money. Hypothetically, you would have 175-ish thousand invested where you have a gain of 75,000 that is absolutely 100% free. So the idea with the Roth is to become, increasingly valuable over time. How can we grow money and have it be free for us later? Does that make sense? Give you in the comparison is this: if tax brackets stay the same from now until you're retired, everything will be even. Okay, so you put $10,000 in your SEP or an IRA, you're going to save $2,200 today if it was a 22% bracket. Okay, now in 20 years, that $10,000 is going to grow potentially to $75,000, where that money is then taxable. So then if you took the money out, you would pay, I guess $16,000. So you're paying more dollars, but the percentages stay the same. If you put 10,000 in a Roth, you would technically pay an additional 2,200 because you're not saving it. But that same amount of money would grow to the same amount of money, meaning your 10,000 is also going to grow to 74,000, which would then be free. When this becomes equal is when people say, hey, I put 10,000 in an IRA and that saved me 2,200. So I'm going to take that 2,200 and save it. But I'll tell you this, not a lot of people do that. People are like, hey, I'm going to save 10 grand. I'm going to put it in one or the other. And if that is the case, technically you would have more money if you put it in a Roth because they're going to grow to the same amount of money. It's just one's going to be free and one's going to be taxable. If you took the money that you saved and also invested it, you would have more money in a pre-tax account, but it would be taxable. So I've seen some people do this, but most people they're not saying, "Hey, Travis, we did this SEP. It saved me 10 grand in taxes. So here's what I'm going to do. I'm going to invest that 10,000." I laugh because it's just not a lot of folks do that. But you could, and in that case, it would be, are my brackets going to be lower in retirement, yada yada. Anyway, there's also this thing called, I don't want to get too much in, and like you can tell me to shut up too, like if I'm talking too long. But if you are somebody that is on this like Roth train, like there's some people that are like, I don't like Roth. Some people that are like, I'm only going to do Roth, and everyone in the middle. You can do. Everybody's heard of a backdoor Roth. If you make more than the limit, you can do a backdoor Roth. If in a 401k, you can do it. Like I'm not making this up. They call it a mega backdoor Roth. I didn't make it up. That's what it's called. Where you can contribute this $30,500 to a Roth as an employee. On top of that $30,500, you can contribute what they call as an after-tax contribution and convert it to Roth, where you can literally contribute $73,000 into a Roth in a year. I've done this for people. I've done this for myself, and it's mind-blowing because I'll talk to people and I'll say, well, I can only put 7,000 in a Roth, and that is true with an IRA. So like if that is something like I'm really into Roth, or you're really, the 401k can make sense. Or if all you're trying to do is like, hey, I just want to save, 10 grand a year and take a tax deduction, then the SEP could make a lot of sense. It's easy to set up. It's up to you to kind of decide that. This is kind of an interesting topic. You maybe have heard of hiring your children to work for you. I take no responsibility in the work that your children do for your business. The reason I say this because you can hire your children to do legitimate work in your business, and I'm sure there's a lot of people that are doing this and maybe not having their kids do actual work, but there is a right way of doing this where maybe your kid or your children are very interested to go into real estate, and you want to get them involved. Your child has their own standard deduction of $14,600. So you can pay your child $14,600 and you would not owe, you would get a deduction and they would not owe tax on it. Now, you want them to be doing legitimate work. Like I have a 2-year-old and a 3-year-old. Like it's just not going to fly if I pay my 2-year-old, my 3-year-old to like run around. You get what I'm saying? But maybe you have like a 15-year-old child that's interested in the business, and this can make sense. Something you maybe want to talk to with your CPA or your accountant. And it is definitely a strategy. Like if you are paying them to do actual work, some of you might have a health savings account. I'll try to go in the chat too. I always see.
Yeah, I was just going to say, Jackie just said, does that include college students over 18?
If they have their own standard deduction, then it absolutely should. The child would owe self-employment. No, because they have their own standard deduction. Meaning each of us, like when you do your tax return, if you're married, you have was it 28,000? It's twice that. So each of us have our own standard deduction. And I should preface this with, I'm not a CPA. So these are all ideas that you want to team with your CPA. I don't file tax returns. I help people strategize their taxes. But you'll want to run these with your CPA. Say, hey, I'm talking about doing this, or I heard about this strategy, and how can this work with my taxes?
So would they, you said that they wouldn't pay any taxes as long as you remained under the 14,600. So if that would be a salary, which would mean that we'd have to set them up on payroll, correct?
You could 1099 them.
Okay,
Now, as for
okay,
that self-employment question in there, that would be something you want to ask your accountant,
okay.
and they'll run an illustration for you. Yeah, I want to give you a yes or no answer. I already messed it up with Michigan, jokingly.
Well, that's odd. So I did a Google search, and you're right. It is like that in Michigan. It's not like that in Florida, but it is like that in California. So it does vary state to state.
Interesting. That's very good to know. Health savings account is something you might have. I've run a lot of people that have one of these already, or maybe it's something you've thought about. It's basically an account that is used for your medical expenses. You have to have a high deductible health plan. There's certain criteria that your health insurance plan has to have to be classified as a high deductible plan and be eligible for an HSA. Uh, but if you are eligible, you can have a health savings account and contribute $4,150 or $8,300 as a family. There's two ways to use a health savings account. If you are somebody that just wants extra deductions, you say, hey, like I can have one of these and I have medical expenses. There's maybe really no reason not to. Maybe it's a way of taking a tax deduction on your medical expenses. You make a contribution, you get a tax deduction, and you can use that money tax-free to pay for medical expenses. You're basically writing off a portion of your medical expenses. So a lot of people will use it this way. They just kind of add a couple thousand a year, and they'll just use that to, like, I broke my toe, I'm going to use that to, whatever. There's another way of using an HSA, which is often called a stealth IRA. I'll get that in a second. But if you contributed your 8,300, you'd save, what is that, $1,800 at a 22% bracket, which maybe is or isn't a whole lot of money, but that kind of adds up, especially if you're eligible and maybe using that money to pay for expenses anyway. There's another way, like I just mentioned, I skipped ahead, but some people call it a stealth IRA. You can invest your health savings account, and instead of using that money to immediately pay for your medical expenses, you can leave it in your HSA to potentially grow. Now, why would you do that? If you are somebody that you've got your IRA and you've got your SEP, and you're just looking for more tax deductions, I don't really want to set up a 401k. I just want to contribute another, $5,000 a year or something like that. People will use a health savings account just like an IRA, because you can put the money in and you get a tax deduction and you can invest it very similarly to an IRA. When you turn 65, you can take the money out and use it for anything. It doesn't at that point, it does not need to be used for medical expenses. Now, along the way, you want to also keep track. So maybe I'm putting money into my HSA, taking a tax deduction, I'm investing it, I have a medical expense. I still want to keep track of that money, because I can still take that money. I could reimburse myself in 20 years for that medical expense. So some people, what they'll do is they'll put the money in, they'll let it grow, potentially, and keep contributing to get their tax deductions, and let the money grow and keep track of their medical expenses. Or maybe now you're 65 and you have 30,000 that you could take from tax free. It's an interesting vehicle because it's the only place you can get a tax deduction. You can grow tax deferred and also have tax free withdrawals on your medical expenses. It's kind of like an IRA that you can withdraw, tax free, up to your past medical expenses. But instead of 59, it's 65. This would be one you want to talk with your accountant also. But if you have a vehicle that is a business use vehicle would it make sense to depreciate that vehicle? Maybe it's just you haven't classified as a business use vehicle. You can depreciate a vehicle. If your vehicle is only used for business purpose, you can depreciate the cost of the vehicle over 5 years, or you can depreciate it in 1 year. Now, when you go to sell that, if you haven't, like, you couldn't buy a vehicle, like, write it off, sell it tomorrow, like, go buy another one, like, you'll recoup some of that if you haven't held that, and that's where you'll want an accountant to keep track of these things. But if you purchased a $50,000 vehicle that's your business use, you could deduct the whole thing in the first year if that lines up with a year that you have really, a good year in the business, or you just have unregularly high income or something like that. This is one to keep track of. When you set up a business account, I did this personally where, like, my health insurance just kind of comes out of my personal account. I keep all my business expenses in my business account. I almost forgot about it. Luckily, my CPA reminded me. You can deduct your health insurance premiums. And I know they're pretty high if you're self-employed, because I deal with this too. So, keep track of the premiums you're paying for your health insurance, and that is a tax deduction. If you're self-employed, you can deduct your health insurance premiums. You, your spouse, and your dependents. And the last thing is just keeping track. So there was a time, I didn't really talk about this, but my grandfather brought my dad, who brought me in the business. There was a few years that I was working with my dad. He was really bad at this. And I remember there were years where, like, we didn't keep track of anything, and it'd be the week before taxes were due, and we're going through, like, receipts and bank statements, and, like, it's just terrible. Like, I have nightmares about it. So, keeping track regularly is a godsend for your taxes. I use an app like QuickBooks. I use QuickBooks Self-Employed, and every week I have a reminder to just keep track of, like, what was business, what was personal. So that way, if you go on a lunch or some kind of checks are the worst, because, like, if you wait, they're just hard to remember. You see, like, check in your 8 months ago, and it's like, what the heck was that for? So keeping track regularly will, aid you in doing your taxes. It's really up to you on what. I talk to people that don't like, I've used QuickBooks Self-Employed for years. I really like it. Keeping a separate bank, on standby if you're in Michigan, maybe it's just a separate personal account that you can funnel all of your business. Okay, like, this card and this account has all of my business expenses on it. So it's easy to find. They're not commingled with my personal bank and my personal credit card and that sort of thing. So that's kind of it. And hopefully I didn't take, what are we at 11? Is that what you do, an hour?
You were literally on the dot.
I tried to be. This is, and some of these things we zoom through. So, I didn't talk about this at the beginning. My job is two-part, is to help people create a plan and manage their investments. I'm not a tax preparer. I can help people create tax strategies, but what I do is help people actively and professionally manage their money and create some kind of game plan. So, two-part. If you have questions, if we don't have time to answer, or you want to learn more, this is a calendar link. Otherwise, if anybody has questions, I got the chat pulled up, or does anybody else have questions?
Yes, I have a question about 401k. I had it like probably 2011 or 2012 when I worked for Home Depot, and they would match $1 for every dollar. And then when I stopped working there, I just kind of let it go. Does that expire, or do I still have money out there in the 401k?
You definitely still have money out there. So I talk about this in one of our other classes. You have options when you leave a career like that has a 401k. You can totally leave it there. I typically don't advise that because they just become difficult to keep track of. They might switch the company, or you just, like, can't log in online. What I'll typically recommend doing is you can roll it over to an IRA. You don't owe any taxes. It's just it's a rollover. It stays in the same kind of um, tax classification, and that way you can like where it is. You can control it better, and then if they switch companies, like you don't have to worry about like okay, it was with Fidelity, and then they switched to like Empower, and then they switched to some other company. So we could talk about that sometime if you're interested. But I would typically recommend rolling it over to an IRA to keep better track of. Does that make sense?
Yes. Who would I contact for that? Do you know?
You would call, so if it's with like Home Depot, you said,
Yes.
so they would have, do you know, I mean, if you knew the name of the company that it's with, so it's not going to be with Home Depot, it's going to be with a financial company, like a Fidelity or something like that, Vanguard maybe.
Yeah, I'm not sure.
That,
It was so long ago, and I was so young. I really didn't care about this then.
yeah, that's something, I can help you with this if you want, or if you have somebody, but typically, like if I have a client that has an issue like this, I'll call, like, we'll do a three-way call. We'll call the company and say, hey, like, we used to work here, or we don't work here anymore. We want to roll this over. And they'll either just write you a check over the phone that you can deposit into, like, an IRA that we'll set up, or they'll have some kind of form to sign. So it's pretty easy to do.
Okay, I'll download your link to get in contact with you.
Yeah, thanks.
Thank you.
And then what do we have? I think the other classes are we have a retirement planning class. There's a little bit of overlap on certain things. There's a budgeting class, which is kind of my favorite on managing cash flow, and then just kind of like one on just some investment and finance 101 strategies and stuff. So yeah, thank you guys.
Thank you. That's so weird. Nikki closed out her thing and it turned to me. It's freaking me out. Oh, it's hilarious. Well, thank you so much, Travis. Really appreciate you coming on. We'll see a lot of you in the next month coming up here. So we got 2 more classes coming up in May with you. So if anyone has any questions, please feel free to reach out. Did you say you were putting a link somewhere, or was that on that slide?
Oh, I can send it to you too, but yeah, I had it on that slide. It's just
Oh, that's okay. We'll keep it on the slide. That's fine. If anybody has any questions or anything, please feel free to reach out to them, and then we will see you guys next week.
Yeah, thank you so
Everyone,
much.
have an awesome week, everybody.
Enjoy the rainy day.
Yeah, right. Bye, everyone.